A lot of people coming in the room. If you are trickling in, a couple things I'm excited to talk about today. A little bit about new legislation, what's relevant to retirement planning. I'm really excited to talk about the investment philosophy and specific things that we're doing. Have a special guest to introduce here in just a minute. But before we do that, all the buzz in the news has been around this legislation. And I'm not clicking. So, and I think we might just have a little bit of delay. Here's my disclosure I have to do anytime we do any kind of a presentation. And it's my proof that, we're starting this after business hours. That is our proof that I do not work with the federal government, right? But don't bump. But let's dig into market update, what we need to know about new legislation, and we will get to our financial strategist who really helps us with the investment committee, building the portfolios for the risk management and the places in the portfolio for growth and strategy. But first, let's dig into this one big, beautiful bill act, all right? OBBBA. I'm thinking of OB cubed, OB3, right? Just to say it, give it a little bit of a nickname. But really what I want to talk about, significant legislation, and I want to talk about how this could impact or pertains to retirement for a lot of the households and a lot of the families we work with. Before we get into this, whether we're talking about this legislation or when we get into the investment strategy and the investment conversation, just know there's a Q&A button at the bottom of the Zoom screen, on your screen. If you have a question as we go through this information, drop it there. And when we get to the end of this, we will take some questions and answer those for you. But first, let's get to this one big, beautiful bill act. So a couple things. Low tax rates, permanent, quote unquote. And the thresholds, the tax thresholds that we have known were technically set to expire on January 1st, 2026. They have been extended and made, and again, I say quote unquote permanent because what that means is they're permanent until they're changed in the future. What I believe it's going to look like is we're going to have 3 or 4 years to do some potential tax planning, some tax strategy with known rates. And why I say it that way is I think of it this way. Would we rather do planning when we know how much tax we're going to pay, or would we rather put it off and pay it at a rate that the government decides in the future? Now, if you really trust the government, maybe that's a strategy. But for me, my call to action for all the households and families we work with is let's use this opportunity to be proactive every single year. Let's look at last year's tax returns as early in the year as possible to get a baseline. Let's look for any zone of opportunities that might make sense, especially for those of you with the buckets of pre-tax money that need to be dealt with. And let's do not let 12/31 of a calendar year go by moving forward to where we didn't at least do the analysis, identify any opportunity, and make a decision on what to do there. Because what happens, right? We're humans and we're dealing with life. We get busy, and how fast does 2 years, 3 years, 5 years, 10 years go by? And if we do that, the risk is we get our pre-tax buckets of money grow, and the tax problem, the biggest tax, ugliest tax money we have, grows. And we've had a couple of examples just recently where we've had some hard conversations to where someone got too far in the timeline to really be dealing with this pre-tax money in a way that didn't drive them into Medicare penalties, extra higher thresholds, and then pay more tax than they would have had to if they would have started dealing with this problem earlier in the timeline. So for those of you here, most of you are going to have to start RMDs, required minimum distributions, at 73 or 75 years old. Now, you may already be taking them, and that could have happened earlier. But if you have a window, whether it's 4 years, 6 years, 8 years, 10 years before that 73, and if you're born 1960 or later, it's going to be 75 years old, when we're required to start taking distributions from those pre-tax accounts, it makes it a lot easier to be doing the work as we go versus waiting till the problem's much bigger and we have much less timeline to deal with. So that's the way I look at the extension of these lower tax rate. We have an opportunity window that we weren't sure if it was going to end beginning of next year, extended, and it's an opportunity to plan with tax rates that are known versus tax rates that are decided by somebody else other than us, and that's the federal government. Standard deduction. Standard deduction was increased $15,750 for a single individual, $31,500 married. Now, something a lot of people, we had a lot of questions about, a lot of information, and a little bit of confusion, is starting this year, for those of you 65 and older, there is an additional $6,000 bonus deduction per person on top of your standard deduction. Okay, this is 2025 through 2028. And what that looks like is, say we're a married couple with a standard deduction of $31,500, we could get the additional $6,000 per person, another $12,000, meaning we could get $43,500 of income coming in the household before we start paying federal tax. Okay, so that's going to be a big deal for a lot of people. And any talk you've heard, this is the next point, about Social Security tax going away, that did not happen at all. That is not the case. What that's referencing is, for a lot of households with that additional $6,000 per person deduction, it's offsetting the tax they would pay on their Social Security. Now, one important thing I kind of skipped over was that bonus, that extra $6,000 bonus, does start to phase out for single individuals at $75,000 of income, and married couples $150,000 of income. So if you're making more than that, there's a phase out all the way to the next $100,000 of income. So if that's the case, we can figure out exactly what that is. But a lot of these things, they're giving us more potential room and opportunity for what we started the conversation with, potentially an extra $12,000 plus of opportunity to do some strategic tax planning in the timeline. Again, especially for that problematic the problematic buckets of pre-tax money that, if they're not dealt with, they're just going to turn into a bigger problem. So really excited about the planning and strategy opportunity in this window. Now, there's a double-edged sword with this. I'm looking at the opportunity and what can we do? What can we control? What can we do about it? Why do I really make the call to let's make a decision to be proactive on this? Is because with the debt that's going to be incurred to do these things, it's even with more certainty and probably higher that we're going to have higher taxes on the other side of this to deal with it. So those that take advantage of the opportunity while it's here to get themselves in the best position possible, have an opportunity to be ahead of the curve or much further down the road than if we wait until the problem's too big. So opportunities for planning, opportunities for strategy. If the tax planning conversation for our households that we work with, if it hasn't come up yet during this year, reach out to the team and let's get it on the books. Let's look at how this impacts your household. For those of you that are joining us more on an educational, but not working with us at this point, just reach out for specific questions, or if there's a conversation that needs to be had, let us know. And I'll give you the contact information here at the end. A couple more things. Nothing was changed with Medicare now, but the talks of the funding cuts looming in the future, they're there. So there are underlying themes of Medicare being an issue we have to deal with in the future. The estate tax exemption rising to $15 million per person, meaning that there may be an opportunity for those households that this applies to, again, in this window of time, get some strategic work done before things sunset back to the much lower estate exemption rate. Now, this is something important that everybody should do, especially if you're already doing charitable giving. You have a charitable giving deduction that's $1,000 per person that's a deduction, comes off the top, and it doesn't matter how much income you have. So if you're giving to church, if you're giving to any causes, $1,000 comes off the top, reduces the taxable income, $2,000 for a couple. So again, we need to make sure that that's just part of the planning and conversation so we don't miss that. Every bit helps. And then this last one, this is a completely different class and conversation, but just know if you're watching and you're a business owner, There's some new planning opportunities for business owners during this window of time. Reach out, let us know, and we can kind of go down that path. Would be completely, again, a completely different class. But for you business owners, there's some tactical strategy that we could be working on in this specific window. So if there's any questions about the One Big Beautiful Bill Act and how it would impact you or your retirement, go ahead to the Q&A button and put them in the chat there, and we will get to those questions. We'll answer all the questions towards the end of the conversation. But the biggest thing is awareness of what the rules are, awareness of how these impact our household, right? That's the check mark. I understand the rules, the new thresholds, the new phase outs, and how it impacts my household. And what can I be doing to take advantage of any opportunities this presents for me and my retirement? And if you need help checking those boxes, let us know. We'll have the conversation and we'll walk through that process. So that's really what I wanted to cover there. There's big things. There's a lot of other things in this legislation we could get into, but these are the things that are going to impact most households, most families that we work with on a regular basis. So let's move on from legislation to the conversation of investments, risk management. One of the components that we talk about, the 5 components of a successful retirement strategy, we just dealt with tax planning, and another component is risk management, or really, if you want to think about how your investments are invested. What's the system? What's the strategy? And I'm very excited to introduce our guest, Jay Coulter. He's our chief investment strategist for investments, and really oversees what we do with portfolios at RichLife Advisors. And just a little bit of background so you know who we're dealing with. Jay has over 25 years of experience in investment management and financial planning. He works with us, the investment committee, consistently to make sure we're on top of all the indicators and things we need to be on top of to make sure we're managing our portfolios properly for the strategies we have in place. He's built many RIAs, but the big thing, there's a $1 billion investment firm and a $500 million exchange traded fund. So he's been on the front lines of investing and the analysis of investments and how to really do this. Right? Held leadership roles at Morgan Stanley, Schwab, other national firms, and authored 3 books. And Jay's nationally recognized for his financial insights, and we're fortunate and blessed to have him on the team supporting what we do in this investment management, risk management area at RichLife Advisors. So I've said enough. As we go through, again, leave your questions in the Q&A tab if you have questions for me or Jay. Jay, I'm going to let you take it over.
Beau, thank you for that kind introduction. I wish you could just go around with me all day and introduce me. That'd be really good for my ego. Hello, everybody. If we haven't met yet, my name is Jay Coulter. I'm the Chief Investment Strategist here at RichLife. Every conversation around investing starts with a reminder of our 5 rules of investing. I'm going to walk you through them. Rule number 1, we want to control taxes. Number 2, we want to minimize fees. Number 3, we want to remove emotions from the investing process. Number 4, we want to reject gurus like the talking heads on CNBC or in the financial news media. And number 5, we want to stay diversified. And the reason these 5 rules are so important is imagine if you worked with us for the next 10 years and we violated even one of these rules. If we didn't stay diversified during the internet bubble in 1999 and put too much of your portfolio into those internet stocks that ended up dropping 90%. Or if we started listening to gurus on CNBC or those newsletter writers that I'm sure spam you like they spam me and started taking financial advice from them. Or if we started getting emotional with our investment decisions. For example, during the drawdown, during the pandemic in 2020, or during the great financial crisis, if we got scared and stepped away from our investment strategy, or frankly, if you paid too much in fees or you paid too much in taxes, you're not going to have as optimal of an outcome with your investments over time. And that's why whenever we look at any type of portfolio or new investing strategy, we run it through these 5 rules of investing. Next, we have a process for going through and building out portfolios. It starts with a globally diversified portfolio. Our portfolios own companies in Australia, Japan, Europe, and the United States and South America. We want to own a little bit of everything, and I'll explain that in a little bit more detail as we go through this presentation. Then we apply some macro analysis, and we take a look at the global economy and try to look at some key indicators that we know really have some implications for the economy and for our portfolios. Then we apply some tilts in the portfolio that we think make sense at this time in the marketplace. And then on a regular basis, monthly, we're reevaluating, reallocating, and rebalancing, if necessary, our client portfolios. So that's the process we go through. Now, I told you we start with the globally diversified portfolio. And then with that portfolio, we have an investment philosophy that is tried and true. It starts with that global diversification. For stocks, as I mentioned, we're owning companies all across the globe. For our fixed income, we're paying attention to what interest rates are doing and credit quality and building portfolios appropriately. And I'll get into that a little bit more later. And when appropriate, we might put some alternative assets in a portfolio if we think it will help the risk return profile for our clients. For example, gold sometimes makes sense in a portfolio. When we build these portfolios, and this is important, we do this with low-cost exchange-traded funds that are going out and giving us access to these global portfolios. And then we're marrying them with high-conviction tilts in the portfolio based upon what we think the indicators and rules of our system are telling us. Now, I've used the term exchange-traded fund or ETF a couple of times now. I want to make sure that if you're not familiar with ETFs, that I make sure you understand why we use them. ETFs were first launched 30 years ago. The first one was created by State Street, and it was a low-cost exchange-traded fund focused on giving investors exposure to the S&P 500. When it came out, traditional Wall Street kind of laughed and thought, well, nobody's going to invest in something like that. And today, exchange-traded funds dominate the marketplace. You see, mutual funds were created 120 years ago as a way for people to go and pull their funds together, have a manager look over those funds, and then be able to collectively report performance returns. But they're inherently flawed, and they're flawed because they were created 120 years ago. They're not very tax efficient, and they are ridiculously expensive generally compared to exchange-traded funds, which is why we leverage ETFs in our client portfolios. Then, philosophically, rebalancing is the key. You know the old adage, buy low, sell high? That's what we want to do in our client portfolios. If the equity markets are doing exceptionally well, sometimes it makes sense to take some of that risk off the table and reallocate that back to our fixed income positions. And vice versa. If there's a major market correction and we have balanced the portfolio properly with some fixed income bonds, we want to go and sell some of those bonds and allocate to some stocks that are undervalued. And then lastly, this is the fastball at RichLife Advisors. Your investment portfolio that you decide to use in conjunction with your financial advisor is tied to your goals. And this is what makes them personal to you and your long-term investing goals. So, given all that, what do we see out there today? So I'm going to start with some data. I love charts. All of these charts are dated for the first half of this year, so through the end of June. The two most common indexes I get asked about are the S&P 500 that you'll see in black, and then the NASDAQ, which is a tech-heavy index that does not have any financials in there. What I encourage you to look at is the lows that we experienced in April in the NASDAQ were down almost 21%. In the S&P 500, we got down to almost negative 15%. Remember, one of our rules of investing is to not get emotional. So when the market is pulling down like that and you have a financial plan, you have selected the right risk-based portfolio for you long-term, this just presents an opportunity when we see corrections in the market like this. And so far this year, we had an opportunity to see a pretty extreme drawdown, for an example. Next is a chart of the U.S. stock market. Here's how we look at the U.S. stock market. So we want to look at the 1,500 largest companies in the United States, and we break them down into three simple buckets. First are our large companies. Those are consistent with the S&P 500. You can see, as from our last slide, that was up just over 6% so far at the midway point of this year. The next group we want to look at are mid-cap companies. So these are companies that haven't quite grown to be as large as the 500 largest companies, but they still have some great size to them. And those are generally the second heaviest weightings for our U.S. exposure in our portfolios. And then the third basket we look at are small cap companies. And you can see here, year to date, our small caps exposures are down 4.5%. Historically, going back 120 years, small cap exposure in a portfolio tends to have a lot more volatility, meaning when the markets draw down, it draws down more. When the markets go up, it really can tend to outperform its larger companies. And if you step back and think about it, intuitively, it makes sense. A capitalist economy wants small companies to do well, to grow their revenues and grow into mid-sized companies and grow into large companies. And that's why we keep small, mid, and large companies inside of the portfolio. The next chart I want to show you is an obnoxious long-term chart of the S&P 500 over the past 10 years, returning 263%. And then a chart of the Morgan Stanley International Index that doesn't include any of those U.S. companies. And you can see for the past 10 years, if you were just picking one horse and you picked the S&P 500, you did so much better than if you were just allocated to the international markets. It's created a real portfolio problem here in this country. And the reason is most people have developed what they call home country bias. Because it's done so well for the past 10 years, people naturally assume that it will continue to do well for the next 10 years. But there's no historical data that actually proves this out. What does matter is being diversified across the whole globe and not allocated to just the United States. So this next chart here will show you why for this year. So from the start of this year until the end of June, international markets were up 18%, while the S&P 500 was up roughly 5.5%, 6%. You're being diversified, our fifth rule of investing, helps save portfolio performance for the first half of the year. And that's why we always preach about the idea of making sure you have a fully globally diversified portfolio. Next, let's look at some of the macro data points that we think are important to keep our eyes on. Now, keep in mind, when we see these data points and when Beau and the team, when we're having our investment committee meetings, we don't panic if there's one bad number for 1 month or 1 quarter. We want to take a step back and take a longer term lens on that data point. Let's start with GDP, which is a measure of the size of the U.S. economy. For the past 10 years, it's grown at about 2.5%. And our last quarter print came out and showed that in the first quarter of this year, we were down 0.5%. There is some anomaly in that data, which is why we want to step back and take a longer term view, because at the beginning of the year, there was a lot of gold repatriation into this country and some issues with tariffs that might have impacted that number. And the preliminary data for next quarter looks strong. So we're looking at a U.S. economy that is growing. The next data point we look at is inflation. And everybody on this call experienced that big jump in inflation that you see on this chart. That was very, very painful. I personally have some struggles with using the U.S. government's data point of CPI or Consumer Price Index because I buy groceries, my auto insurance is going through the roof, and there are other things that cost way more and are up significantly more than this chart shows. But these are the data points that we have when we're looking at portfolios. For the last decade, CPI has averaged about 3%. And you can see on a relative basis compared to where we were several years ago, we're seeing this inflation number come down. So we're keeping our eye on that, but we do have some concerns. Next, we look at the unemployment rate. I am 52 years old. I remember when we would have unemployment rates of 7, 8, 9%. When I talk to some younger advisors and investors, it always amazes me, but they've never experienced an economy like that, other than that short blip during COVID. And when the unemployment rate gets up above 6%, it gets very, very painful for investors and for people living in an economy. Today, with our unemployment rate at 4.1%, there are lots of jobs. We do have some concerns, and we're keeping our eye on the implications of AI and what it could do to some industries. But as a whole, as a country, unemployment rate at 4.1% tells us we are in a good spot there. This chart is of real concern. So this is a chart that shows the U.S. debt as compared to our GDP, or the size of our economy. I just have a hard time thinking, Beau, we're ever going to do one of these review meetings and I'm going to say, hey, guess what? Our national debt has fallen significantly. So because of that, we want to measure the debt as it relates to a percentage of the economy. You can see this chart here goes back to the 1960s. If I had a chart that went back to World War II, that would be the last time you saw our debt to GDP number this high for this long of a period of time. And so this is something we want to be careful of. Beau mentioned it in his comments. We also think this could have some real implication for inflation and the potential for inflation to rear its ugly head again, and we want to account for that in our portfolios. The next chart that we pay attention to is the 10-year Treasury rate. Now, if you read the Wall Street Journal, follow financial news media, and they talk about rates, there's generally one of two rates they're talking about. Sometimes it's this rate. The U.S. 10-year rate, you can see over the past decade, has averaged 2.6%, which is an astronomically low level. You can see during COVID how low it got, really bringing that 10-year average down. But today, we're sitting at some really high levels for the 10-year rate. As of the end of at the end of June, we were sitting at 4.42%, which has some real implications in the economy. Let me explain with another chart. So the U.S. mortgage rate is tied to the 10-year Treasury. And the reason for that is most people refinance their home in 8 or 9 years. So it's a good indicative number of directional risk for mortgage rates. This is a 50-year chart of U.S. mortgage rates. My dad told me stories about getting a mortgage in the early 80s at 18%. Also walked to school uphill both ways. But then look what he got to experience the rest of his life. Mortgage rates, coming down precipitously. And then we finally hit a low at 2.6% several years ago. And then this massive spike up. The spike up came because of the spike up in interest rates. And here is the ramifications of that. This is showing the 30-year mortgage rates and U.S. existing home sales. Home sales are in black, and you can see home sales are dropping because interest rates have gone up and the housing market is thawed. It's frozen, And we need the housing market to unthaw because that could really unleash a lot of good here in the economy, but we're not quite sure how that's going to happen. So we're going to keep watching it. And then lastly, when people talk about the Fed, people in Washington talk about their irritation with the Fed. What they're really hoping to see is the Fed funds rate, which is the short-term borrowing rates, to go back down to levels that you can see here in 2016 and 2020. If the Fed were to lower their Fed funds rate, that could potentially unlock some of the credit market, but not necessarily the mortgage market. But what it would do is free up lending. Lending then puts money into the economy, which then has implications for growth and inflation, which is what we want to keep monitoring in our clients' portfolios. So, given all of that, our process, our philosophy, how we see the data points today, here's how we're building portfolios. As I mentioned, we start with a globally diversified portfolio. We own companies in Australia, in Europe, in Japan, in the United States. We own large companies through the S&P 500. We own mid-cap companies through the S&P 400. And then we own small-cap companies. We take those stocks and we balance them against a portfolio of short-term, high credit quality bonds made up of U.S. Treasury bonds. When you work with your advisor, you determine what is the correct proportion of equities and alternatives to fixed income. And then today, our rules-based system, Beau, I think I forgot to mention that in the beginning. The RBI portfolios is an acronym for rules-based investing. Today has 3 tilts in the portfolio. First, we have a small allocation to gold. That indicator is triggered if that debt to GDP number is above 100%. The reason is there's the risk of potential higher inflation, maybe even runaway inflation. We don't know. But when our debt to GDP is at that high level, we want to have an allocation to gold in the portfolio. Our second tilt is to another rules-based strategy that will give us a little bit extra exposure to the S&P 500 if the S&P 500 is trading higher than its 200-day moving average, which in simple terms, if it's trending above where it's been for the past 10 months, we want to be in it. If it's trending below, we have a set of rules that move us into a cash position. It's not Jay or Beau or the rest of the team making the decisions. It's based upon a set of rules. Where that helps is in periods like today when the S&P 500 seems to be going crazy. We know that we have some extra exposure there and a set of rules to get us out if it starts falling below its average. And then our last tilt is a solution where we take a look at the high-flying NASDAQ 100 and we look at the S&P 500 equal weight ETF, which is the equal weight ETF has the same weighting position for the 500 largest companies. The traditional S&P 500 puts higher weights the bigger the company is. So NVIDIA and Microsoft have much higher positions than, say, John Deere in the S&P 500. What we know historically is that when the U.S. markets are really doing well, the NASDAQ 100 tends to do a little bit better. We also know that when the U.S. markets are not doing well, an equally weighted portfolio of the S&P 500 names tends to be more defensive. So today, our rules tell us that the NASDAQ 100 is doing better than the equal weighted portfolio, so we have more of a tilt towards that position. What this means today in our client portfolios is we have a heavier tilt towards the United States. Our client portfolios own all the names that you see in the news. They own NVIDIA, they own Microsoft, we own Meta, but we also own those companies in Australia, Japan, Europe, so that we have that full global diversification. With that, Beau, I will turn it back over to you.
Jay, thanks so much for digging in to the indicators. And the reason I'm sharing this, and Jay's going to join us quarterly, and there's a reason we're building it this way, is I find a lot of families, a lot of households getting statements with a bunch of names on it doesn't necessarily mean a lot. And the kind of transparency and access we have, having Jay come on these calls and share where are we invested and why. That is structuring the families we serve in a very similar model to an ultra high net worth family in a family office. We're literally able to kind of invite you into a quarterly investment committee meeting. So I think that's important. And I think that's going to be really valuable as we continue to enhance that risk management and investment section of the planning. So let me know, give me feedback, but unless we hear that's not helpful, quarterly, we'll do these updates and reports. And I want the families that we work with and serve with confidence to say, understand what we're invested in, what I'm invested in, and why. And Jay, thank you so much for bringing that technical expertise. God bless you. It takes a special person to do that work, right? But thank you so much for that and your willingness outside of the investment committee meeting in-house to share with our families and households here.
My pleasure. You can tell I'm passionate about it.
Yeah, you get excited.
Thank you.
Right? Tonight, as we kind of wind down, here's the model. We call this a roadmap to a rich life in retirement. The acronym ROUT. We're talking about the 5 core areas. We talked a lot about risk management, or Jay got into that, the philosophy, the rules. income planning, unexpected healthcare expense. I talked a good bit about some of the tax planning opportunities that are going to be available, at least in this next window of time that's defined. And then estate and legacy planning. One thing I always want to reiterate is at the top of the model, we had to add, at RichLife Advisors, we had to add that you. So insert your name or your household name. And the reason is we need to have all those plans buttoned up to where we feel confident in the plan in each of those areas. But until we have the context of you, your values, the things that make your life meaningful and fulfilling, then and only then do we have the context to build and do really top tier financial planning to move you towards those outcomes. So all that to say, if today brought up any questions on the investment, or it's time to have an investment review or an annual review, or if talking about the new legislation and some of the ways that can impact retirement resonate, or we haven't done tax planning yet this year, reach out to the team. Usually what we find is if there's an area to where we're feeling it's not completely buttoned up, I'm 8 out of 10 on a score of 1 to 10 in any of these areas. Usually the step to address it is to start with a conversation. So let us know. We're here for you guys. Let me switch the slide there. There we go. There's the team information. You can call the office 770-249-7424. That's 770-249-7424. info@richlifeadvisors.com. Either of those, just let us know anything. If it's time for a meeting, a conversation, what we can do to support you in your successful retirement and anything you need. And kind of just, again, I'm excited about this. And again, let me know. Your feedback's important to us, but I really believe that what we just did and what we're going to start doing quarterly with Jay is going to be a very valuable piece to your confidence in retirement planning. So give me feedback there. And if you have questions, go to the questions tab and we'll answer them. I had one come in. How many times has Jay's portfolio? So Jay, this is a question, and I think you can frame this the way you would, because I'm sure you've heard something. How many times has your portfolio beat the S&P in the last 10 years? So we're looking for returns. So how do you answer that question?
Yeah, Brian, fair question, Brian. First, let's set a little bit of context here. It's definitely not my portfolio. These are run by a set of rules. If I get hit by a bus, the team is able to go and execute on what this rules-based strategy looks like. As far as actual data points for it, obviously this year would have done better because the global markets have outperformed domestic. But I think that's really the wrong way to look at it, because there are going to be periods of time that it's dramatically underperformed, especially because of the dramatic outperformance of the S&P 500. Today, there's actually more risk in the S&P 500 because it's been bid up so much by some of these large names like NVIDIA and Microsoft doing so well, which feels great on the way up, but creates a problem on the way down. So the specific answer to your question could be found in a data set you could get from the team, but it's not going to be for the last 10 years because the S&P 500 has done so well. If that's the only asset you own, just the 500 companies, there will be more periods that you outperformed. Does that make sense?
Yep. No, that's good. And I think that's the I think it's the context of what is the long-term goal, and are we looking, where is in a lot of our framing, we consider these what we call third bucket assets, long-term growth and strategy. Mm-hmm. And what we're looking for is efficiency there.
Well, but I'd also add, I wish I had added this, and Brian might appreciate this with this question. Mm-hmm. So if you were to have invested in the S&P 500 in 2000, you dramatically outperformed the equal weight S&P 500 as opposed to the cap weighted one that ran up for a decade. And that's why it's so important not just to be allocated or have overexposure to the cap-weighted S&P 500. But keep in mind, in our portfolios, we've got our fair share of the S&P 500 today. But you just want to make sure that you right-size that risk so you don't have lost decades like people experienced from 2000 to 2010.
Yeah, and I think the example of kind of the international performance recently It happens in periods of time. So any other questions, guys? Again, thank you, Jay. Thank you, everybody, for joining us. We had a great group come in today. Any other questions before we call it a day?
Oh, you do have another one.
Okay, you see it?
Yep. Here, I'll read it to you, Beau. With the new big bill, new big beautiful bill, looks like there's a great opportunity for Roth conversions. What are your thoughts, Beau?
Hey, Pete. Yeah, for a lot of households, it's we talked about the additional deduction, the known tax brackets, right? So it gives some, from a mathematical perspective, it gives us some certainty in planning. And for a lot of households, there's going to be more room to get more of that pre-tax money shifted over within current at lower tax rates than it's going to be down the road in the future. So Pete, you're exactly right. Of course, it always depends on the household. It depends on how far you are in the timeline. The strategy is going to lay out different if you're 65 and we have 10 years versus if you're 70 and we have 3 or 5, or if you're 80, right? Then there's different scenarios based on where you're on the timeline and how much work, how much heavy lifting needs to be done to prevent some problems. And another thing with that, Pete, you brought up a great question, and I know you well know this is important to you. When you're dealing with pre-tax money and Roth conversion, the two things that are the big issues is making sure we don't get caught too far in the timeline with the RMD trap, meaning the required minimum distributions we can't control anymore. They're driving us into higher tax brackets, higher penalty windows with Medicare surcharges. And then the second thing, so RMDs, because you'll hear a lot of reasons about why Roth conversions are good. The two main ones are, is there a problem for required minimum distributions? And for you couples, what is the impact? This is important. What is the impact on my surviving spouse down the road if I don't do some of this work and get some of this pre-tax money shifted? Because we can see some scenarios to where not only is a surviving spouse paying higher tax rates overall because they went from married, joint to single, standard deductions cut in half, but it makes things a lot more complicated or more expensive, or there's more tax paid on money that's left, so it's less money that the beneficiaries or surviving spouse get to use. So those are things we want to look at and make sure there's not an issue or make sure it's dealt with. And again, on the timeline, for those of you that have that window, we're in our 60s now and have until our 70s to deal with this. I would use these years to make sure we're chipping away at any opportunity, because once 1231 passes, we miss that year, right? And my concern, and any group I talk to, I've yet to have somebody tell me they don't believe taxes are going to be higher in the future. So my concern is not just are they going to be higher, how high might they be or what's possible? And some of the stuff you hear out there gets a little scary. And we could look back historically and see some of those scenarios. But great question, Pete. And thanks for bringing that up. Any other questions? All right. We were able to answer a few as we kind of went through there. And Jay, how about we do this again in a quarter and check in, see what the world's doing, see what the economy's doing, and see what makes sense in these portfolios we're building to help people grow their wealth and outpace inflation and have a successful retirement. So that's the goal. Excellent. Guys. And I appreciate you, Jay. Thanks everybody for showing up. Let us know if you need anything. The information's on the screen there. We'll talk to you soon.